Joe Zeidel, Chief Investment Strategist here at Blackstone, and I'm joined by Byron Wien, Vice Chair, and my partner in investment strategy. Welcome, Byron.
Good to be here, Joe.
Today's webinar is going to follow a slightly different format than what many of you watching are used to. We're still going to highlight our favorite charts, but we're going to engage in more of a debate. This is partly in response to your feedback, but it also reflects our view that investment strategy is the business of assessing probabilities. At this point, neither of us can determine exactly when the next recession will occur. What our debate will do is help you make your decisions on how to position your portfolio for that event. Over the next 45 minutes, we will give you a look at some of the behind-the-scenes debate that Byron and I engage in daily. We hope that it stretches your thinking. Before we begin, one programming note. The slides are available for download on the same webpage that you'll be watching this webinar. With that, let the debate begin. So the title of this presentation is The Timing of the Next Recession. And as I said, we're going to take you through a number of different categories. The slide deck that is available for download contains our full slide deck, although in this webinar, Byron and I are only going to be hitting on a few of the slides that we consider to be most timely or actionable and help frame the debate that we're having currently. And before we begin, Byron, maybe I'll ask you to take us through the 10 surprises.
Okay, well, we're having a pretty good year, Joe. You and I worked on this together. They were announced in January. We said interest rates would stay low. They got a lot lower than either of us thought. We thought the market would be up 15%, and it exceeded that. We thought that capital spending and housing would be modest in their increases, and we thought at that point that a recession would not occur before 2021, and that's an issue we're going to be debating about during the course of this webinar. One of the things we really got wrong on was that gold would drop to 1,000, and gold has been strong. The reason we got that wrong is we thought both stocks and bonds would do well, and there was no reason to hide in gold. But in fact, the geopolitical situation and the uncertainties related to that caused gold to rise in price. We thought that the emerging markets would do well, and generally they have done well. And moving on to the next page, we thought March 29th, which was the original deadline for Brexit, would come and go. And we think October 31st will come and go. We think it would be a tragedy if Britain left the European Union without a deal, and somehow we still believe a deal will be struck. We thought the dollar would stabilize. It's been strong, but we think it doesn't have much further to go. The Mueller investigation did not provide some of the juicy material that some people were looking for, but it did include some information that will probably be used in the next presidential campaign. We thought Congress would get more done, and now with the impeachment underway, I don't think they'll get much more done, and we still believe growth will outperform value. So it's been a pretty good year so far. This is the radical asset allocation. We've made some important changes in it. We're still at 5% on global large cap multinationals, but we've reduced the U.S. from 15% to 10% because the market has done so well in the face of problematic circumstances. Europe is still 5%. Emerging markets we're keeping at 10 because we're hopeful there. Japanese equities we reduced to 5. Hedge funds, private equity, and real estate are each at 10. That's where they've been. Nothing in gold. Natural resources directly 5%. Still 15% in non-sovereign debt. High yield bonds, mezzanine financing, leveraged loans, some emerging market debt. What we've said is that you should seek yield in the fixed income, and mortgages can provide a good return. And for individual investors, municipal bonds are still attractive. And then we took the 5% that we took out of the U.S. and put it in cash. So we wanted to have a little more in reserves for the opportunities that may develop during the course of the next year.
And, Byron, it's worth pointing out that you launched this radical asset allocation in 2011, and we went back and looked through the archives, and the 15% cash position is the highest that we've had since you launched that allocation in 2011. For the most part, it's fluctuated between, say, 5 and 10%, but 15 is a high for this cash position.
Well, the risks are out there. It isn't, I have more optimism than you do, but I recognize the dangers that are lurking.
All right, and we'll talk a little bit more about that.
So this one shows that we got, the best time to buy stocks was Christmas Eve. Most of us were celebrating the holiday, but that was an ideal time. Sentiment was very negative. Valuations had come down in the fourth quarter of last year. We're now in optimistic territory, but not in extreme optimistic territory, so the market can make some further progress. But we're definitely not in the ideal position to be a heavy buyer, and that's one of the reasons we raised a little more cash for the radical asset allocation.
Well, the topic of our fourth quarter webinar being recession timing, this is a table that I'd put together just as an internal checklist, if you will. And I've broken the slide up into two sections. Number one are the top, which are primary indicators. And the section on the bottom, I would consider to be secondary indicators, or more like preconditions for a recession. And you can see on the far right-hand side, we note the current present situation, but we also plot it relative to what we saw in the housing bubble and also the tech bubble. And the thing I would draw your attention to are just those components that are on the top: the yield curve, leading economic indicators, and average hourly earnings. And the yield curve is one that I consider to be most important, but I would note here, it doesn't really take more than one of these indicators to trip a recession warning. Certainly more than one becomes of a greater concern. But the yield curve is one that I consider to be the most predictive of these indicators, and particularly the tens twos portion of the curve, which we'll talk more about later. But the second thing that is of concern here are leading economic indicators. They've rolled over. They've been on the decline now for about 10 consecutive months. They're still in positive territory. When LEIs flip to negative territory, then it becomes even more concerning. The last component on this set of primary indicators is average hourly earnings. And this one seems a little bit counterintuitive, because normally when average hourly earnings cross above 4%, it's normally associated with Fed hiking, inflation, and then ultimately recessions. And average hourly earnings have stalled below 4%, so it's not yet of concern. The bottom part of the slide contains what I consider to be the preconditions. They're things like consumer confidence. It needs to roll over, which it has. The unemployment rate needs to back up. It hasn't yet. Corporate profits, we'll talk a little bit more about that later, but you need to be in a corporate profits recession in order to have a recession occur. And then investor sentiment, which is something Byron covered up front. Now, I want to highlight this chart. This is one that Byron and I have had in this webinar now for at least the last 4 quarters, because it really does tell the long-term picture of the U.S. economy and what to expect. And particularly what I would draw your attention to are the second and third bars, which are productivity growth as well as labor force growth. And the reason why I mention this is because when you think about GDP growth over the long term, it's really no more complicated than adding up the change in population plus the change in productivity. And you can see if you add the two of those up today, it tells you that your potential GDP in the growth in the United States is around 2%. That's down from what we experienced historically. Historically, your productivity growth and your population growth would add up to around 3%. And that was about, the historic, GDP growth from the 1960s through 2008.
But it hasn't been that way, Joe, since the Great Recession. Since 2009, we've struggled to get above 2. Only when Trump boosted the economy with the tax cut did we have a 3% year.
Yeah, that's right. And that's, what we're looking at this chart. And I think what it illustrates is that sugar high. Now, what's interesting is if you look at that peak after the 2017 tax reform, if you were to look at that peak, you could almost draw a pretty strong connection between that and the beginning of the trade war. And that's something that we'll come back to a lot, because I think the trade war has had more impact than most people think. And there's a lot of unintended consequences, which we'll hit on. This is a chart of the leading economic indicators. As I mentioned, these have rolled over. That's a precondition. That's a warning of recession in the United States. Now, the LEIs are still in positive territory. They're just about at 1% or so. When the LEIs turn negative, if they fall below zero, that's really when you get your strongest recessionary warning. But what this chart here illustrates is the relationship between the leading economic indicators and GDP growth. And they do their job. They lead, and they're telling us that no matter what, growth is slowing. I think the question will be to what extent. And this chart, I think, is probably one of the more important ones, at least from my perspective, and it is the chart of the yield curve. There's not a lot of new information that we'll share with respect to the power of the curve, but what I'd highlight on this chart is each of these arrows. And the reason why I want to spend a minute on these is because if you think about the value of the yield curve, right, it's most valuable when you understand that it historically inverts when times are good, as opposed to when the data's already rolled over. So if you look at the previous 5 inversions of the curve, whether you're talking about 2006, whether 1998, 1988, et cetera, what you'll find is this. If you look at each one of those previous inversion points and you look at consumer confidence, initial jobless claims, the unemployment rate, if you look at capacity utilization, what you find is that generally the economic conditions are good, and in fact, in a lot of cases, are actually improving. So the value of the curve is this. It challenges your conventional wisdom, and it's generally right. Once the curve inverts, the data tells you you've got 20 months before your next recession, which again is why I think we need to start the countdown timer here.
But Joe, let me just ask you a question about that. The 10-2s have been inverted, but they flirt with inversion. They turn positive from time to time. So it hasn't really been a sticky inversion. It's been an erratic inversion.
Yeah, and I think even when you brush with an inversion, I think the signal is still pretty strong.
Okay, this one is my favorite because this shows you that there's something different about this inversion. Usually the inversion is caused because the Federal Reserve raises short-term interest rates, so they're above long-term rates. But this time, the curve, and it's not the only time it's happened, but it happened very profoundly. Look at the right chart. It shows that long rates went below short rates. Short rates didn't go above long rates. It's long rates that came down. And why did that happen? It happened because there was so much liquidity out there looking for a place to hide. And that's why long rates dropped precipitously. That's something that's unusual. And I think it argues that maybe we're not going to have a recession as soon as you think, Joe. And there are a lot of other differences. I'm not going to get into the trap of something's different this time.
You beat me to the punch on that, Byron.
But let me tell you, if you look at 1990, you look at 2000, you look at 2008, in every one of those conditions, the real federal funds rate was strongly positive. It was 900 basis points in 1990. It was 500 or 400 basis points in 2001, 250 basis points in 2000. Also, there was some event that took place. In 1990, the Japanese stock market bubble burst. In 2000, the tech bubble burst. In 2008, the housing bubble burst. Well, let me give you a couple more. Oil prices surged in all 3 instances, and inflation moved above 4%. So I'm not arguing that something's different this time. I'm arguing that there are conditions that are not in place now that make me think the recession will be later rather than sooner.
Yeah, and I think, when you go back to each of those periods you mentioned, if you think about the conventional wisdom at that point in time, there was always something different, right? So today, the point is that, there's distortions in the yield curve, right? And they're distortions because, maybe the Fed's cutting proactively instead of reactively, whatever it is. But in 2006, when the curve inverted, of course, the popular argument was, well, housing prices never fall. We know how that ended. 1998, the curve inverted, and this is my favorite. People said technology had created a new paradigm, therefore making business cycles obsolete. In my simple mind, I thought, oh, because I can now buy my dog food online, we'll never have another recession again. It makes perfect sense. So I think what's important to keep in mind is that every stage along the way, when we have these inversions, people look at the data, they think the data is pretty good, so something must be different. And that's the trap that I would warn our listeners against falling into.
Okay, the lines are drawn. The next webinar, it will be the 10 surprise webinar in January.
The 10 surprises webinar with or without me?
With you.
Okay.
But we'll have more data on this. We'll have a clearer picture of the outlook for 2020. And probably one other thing to think about, Joe, is 2020 is an election year. One thing we know, Donald Trump does not want to be running for reelection during a period when the economy is in a recession. So we'll shed a lot more light on this debate in January.
Yep.
Okay, this is some support from my side. The consumer has really been the driving force of this economy. The consumer is in pretty good shape. Unemployment is low, average hourly earnings are increasing, and household debt is at a very low level. So the consumer has the resources to keep spending to hold the economy up through another year.
And this is, of course, key, because if you think about the consumer, it's, of course, 70% of the U.S. economy. If you're to take the consumer and put them on as their own sort of like entity or economic force or country, if you will, the U.S. consumer would represent 17% of global GDP, ahead of China, which is 16% of global GDP, and the whole rest of the United States would just be 4% of global GDP. So it does argue well, and that it is good that the consumer continues to be in this condition.
This shows, this is a disturbing one, but it argues against my position. It shows that non-farm hours and payrolls are decreasing and job openings are decreasing. So this is an argument on the other side of the consumer.
Yeah, it is the beginning. It might just be a crack in the leading edges of labor markets. And I would actually argue that this could be a reflection of trade, which we'll talk a little bit more about later. But what it suggests is that, there is a manufacturing recession that's going on globally. And what it suggests is that it could be just beginning to spread into the non-manufacturing side of the economy. This is an important one. This is corporate profits. And I mentioned it's important because if you go back to that recession checklist monitor that we highlighted in the beginning, you've never had a recession starting when corporate profits are accelerating, when they're positive and they're growing. And so far in 2019, we've narrowly avoided an earnings recession, right? Not every earnings recession translates into an economic recession. They don't always line up that way. But at the very least, you have to have negative year-over-year corporate profit growth in order to see a recession. And in the first couple quarters of 2019, we've seen earnings growth that's basically about zero. Looks like with third quarter profits beginning to be reported, we're again looking at something that could be approximately zero on a year-over-year earnings growth rate. But fortunately for the economy, we've avoided an earnings recession.
This is a dividend discount model, and it shows if you assume that stocks and bonds compete with each other, we're in very attractive territory. At around 150 on the 10-year Treasury, the model, which has served me so well during my career as a strategist, would argue strongly that the market should be well above 3,000 on the S&P 500. And even if rates go back up, if you assume that the S&P 500 next year will earn something like 170, then the market would still be well above 2,000, but below where we are right now. But at any rate, at current interest rate levels, the bond market can certainly support a higher multiple. And in terms of multiple, the market right now is at about 18 times earnings. It's not excessively priced as it was in 2000.
Byron, we just argue, or I just argued that it's never different this time, right, on the yield curve. And I always harken back to the words of Sir John Templeton, who said, or said something approximately like the four most expensive words in the English language are "this time is different." That said, how do you think the ultra low yields we're seeing on the 10-year Treasury, how does it impact the way that you would use the dividend discount model? Is it being distorted because of the low rates?
Yeah, I think it's being distorted because of the excess liquidity that's been created during the last decade. In the year 2008, we had $3 trillion on the balance sheets of the major central banks. We now have $16 trillion. And a lot of that money is looking for a place to hide, as I said earlier, and that's going into sovereign debt. That's why you have negative rates in Europe and Japan, and that's why you have very low rates in the United States. The United States is the highest yield place to put your money in a sovereign.
So a couple slides here on inflation and implications for Fed actions. So what the slide looks at is average hourly earnings. And again, this is one that does appear in our recession checklist monitor, because historically when average hourly earnings are moving up at 4% or greater, it is associated with inflation, Fed hiking, and ultimately recessions. What we're looking at here is actually private production and non-supervisory employees, and this has actually been running a little bit hotter than total private employees. But nevertheless, we're still below that threshold, which would be a concern. Now, with unemployment at 3.5%, basically a 50-year low, I think we will end up seeing more wage price pressure here. We could end up flirting with that 4% level sooner rather than later. Now, this chart looks at another issue that I think is important, and that's core inflation. And this is CPI, core CPI, so CPI minus food and energy. And again, it's now at 2.4%. It's one of the highest readings. It's the highest reading we've seen since 2008. And a year ago, Byron, if someone were to say, we would see a 50-year low on unemployment at 3.5%. We'd see wage growth, which is still decent. We'd see housing prices that are still moving up, and the Fed would be cutting. I would say that's absolutely ridiculous. That's impossible, because at a core CPI 2.4%, that's something where normally you'd actually see Fed hiking. But at this point, it looks like the Fed's more interested in being a global central banker versus just dealing with the conditions here in the United States.
Well, I just caution you. There are too many people making too much stuff out there, and there are too many people who want a job, any job, and that keeps inflation low.
Yeah, well, there's other source of inflation. Core CPI, when you look at the formula for core CPI, so you've removed food and energy, 60% of the core CPI formula ends up being shelter, right? That's single family, that's multifamily, and we know those inventory levels are very low. So that suggests there could be more upward pressure from housing. And then let's not forget trade. There's real trade friction out there, which could either translate into a PPI story, which would be corporate profits, or at some point it could translate into a consumer inflationary story.
Okay. In terms of core imports, they've been coming down. They may be bottoming. You see this core import price on the left-hand scale and the core PPI on the right hand. But you see in the core import price, that may be bottoming. So that may contribute to your concern about higher inflation.
Yeah, you think about take electronics, take the manufacturing process for Apple's iPhone and the older generations of the iPhone. I can't speak to the new one, but when we looked at the manufacturing assembly process for the iPhone 7, for instance, or iPhone 6, I think it was, it travels through 45 different countries. It's touched by over 1,000 suppliers. It has components from over 1,000 suppliers. And amazingly, if you track that supply chain, the iPhone will travel about 500,000 miles before it's ever sold. In other words, it's going to get upgraded on United before I would. And I think with trade wars, which is the U.S. and China, the U.S. versus the rest of the world, Japan versus South Korea, it suggests that at some point you're going to see either this PPI story or the CPI story. I think with greater friction, I think it just increases the odds of those unintended consequences.
The forward rate implied by the futures is we're currently at about 1.75 to 2. We're going lower. So I think we will have one more 25 basis point cut. I don't know if we'll go beyond that.
What do you think the Fed should be doing? You said you don't know if
I think the Fed should stop here. That's what I think.
Yeah, it's the beginning of a core, CPI story. There's
Yeah.
other inflationary pressures out there. I think it's going to be very problematic between the market, which wants more cuts, and the Fed, which may not deliver it. And 2019's performance year to date has really been dictated by liquidity. And if the market doesn't get the lower rates the way it wants, I think some more
Rates are
volatility.
low enough. If you want to borrow money for some constructive purpose, you can borrow money very attractively. So lowering rates just boosts the stock market. It doesn't really help the real economy.
So now we're looking at global forecasts. And what this table highlights is really that growth all around the world has come down. It's in my opinion, partly due to global trade. And if you look at countries like Germany, or if you look at the broader Euro area, you can see they tend to be more trade exposed. If you look at Germany's net trade, which is a combination of their imports plus their exports, it ends up being about 85% of their GDP. Now, not on this table are Hong Kong and Singapore. And both Hong Kong and Singapore have net trade, again, the value of their imports plus their exports, at over 300% of their GDP, and both are experiencing recessionary conditions today. I think the longer that trade problems persist, the more we're going to see downward pressure on global growth.
Okay, on Brexit, this shows the impact that it's had on the UK. It's really knocked several percentage points off potential growth, and it's hurt the European Union also. So I think there will be a postponement of the October 31st deadline. It'll be to December 31st, and I think there will be a deal before that. Whether there'll be another election for a vote of confidence in Boris Johnson's leadership, I don't know. That's certainly a possibility. But I do know that Britain can't leave the Union without a deal.
Yeah. I would say this: if you were a long-term allocator, I think the UK would actually be pretty attractive to commit capital for the following reason. A lot of people, obviously everybody, a lot of people are focused on this, and I think the general consensus is that it's anywhere from bad to a disaster, as you just mentioned. But if you think about whatever the UK might look like 2 to 3 years from now, my guess is it won't be nearly as bad as what people are projecting into it today. In very simplistic terms, I think back to our own experience with the Y2K bug, the year 2000 bug, and that was an example of people being conditioned to believe that on December 31st, 1999, the world was going to stop. Planes wouldn't take off, they wouldn't land, ATMs wouldn't spit out cash, and we know what happened. It ended up being really not much of anything. Obviously, Brexit has got farther, reaching implications. But at the same time, you have an example of this great unknown where people are projecting their worst fears. And if I were a long-term allocator, someone who could withstand the headline noise of the next, 6 to 12 months or maybe 24 months, I actually think it'd be fairly attractive. How would you react to that?
Well, I mean, if you're right, the British pound is very attractive. And there are real opportunities there. And I think, as we said at the beginning, this is a probability business. And I think the probabilities are favorable rather than unfavorable.
Well, at this point, let's turn to the Q&A portion of the program. And we did receive some questions in advance, so we'll go through these. First, and maybe Byron, I'll start with you on this. What are your thoughts on Trump's 2020 reelection prospects?
Well, look at this. It's pretty evident. If we have a recession, the chance of him being reelected is not particularly good. And if we don't have a recession, the chance of him being reelected is perfect. And if you look at the right-hand chart, if the unemployment rate is rising, that's not good for the reelection. If it's declining, that is. So this, Donald Trump is well aware of these conditions, and he's going to do everything in his power, assuming he wants a second term, to make sure the economy stays at full employment and doesn't go into a recession.
Second question is, what is the U.S.-China trade dispute about?
We really need a deal. China is gaining on us, as Satchel Paige famously said. Look at that left-hand chart. And, my view is China will pass us in real GDP. sometime in the next decade, not in the 2020s, but in the 2030s. And trade with China is very important. Trump needs a deal with China politically, and China needs a deal with the United States economically. But the differences between the two countries is very sharp right now. China is not going to give on intellectual property, and Trump is not going to do a deal without getting China to be more in line with the world in terms of intellectual property. So my view is that China is not going to do a deal until a major deal, maybe a cosmetic deal, but not a major deal until after the 2020 election.
So I think the bottom line, I think you and I agree on the timing of all this. And I think the bottom line for viewers is this: don't expect anything comprehensive in the short term, because I think both parties have an incentive to draw it out further. And I think it will go longer than most people expect. The next question is, what is the long-term outlook for global growth? So this chart, I think, ends up being an important one for setting long-term growth expectations. And, the left-hand side shows global GDP growth is forecasted to really come down pretty substantially from what we experienced for most of the second half of the 20th century, right? From 1950 to 2014, you had global GDP growth that, approached an average of almost 4%. But the changing demographics are such that the growth rates going forward are going to be a lot slower, simply because of aging demographics throughout the developed world, as well as a lot of the larger countries in the emerging markets. So what that will force us to do is rely more on productivity. And as you can see, these longer-term GDP growth forecasts really assume a productivity level close to 2%, about 1.9%, and that's a number higher than we've seen, even in the most recent, few years since the post the Great Financial Crisis. So as we look at this as a baseline forecast, I still think that growth could end up being lower than this over the long term, and it simply just reflects a new dynamic, which is aging demographics. Productivity will help to a degree, but it's going to be a supporting factor versus a driving force, in my opinion.
Yeah, but that sings out to us what we think about the next decade, the decade of the 2020s. Get ready for lower returns. The double-digit returns that we've enjoyed over the past several decades are going to be hard to come by. We should look forward in terms of equities to single-digit returns, maybe mid or low single-digit returns. Equities will still outperform bonds, but the total return will be much less than it has been.
Yeah, and I think one of the key points is something you mentioned earlier about valuation, and we're looking at a PE on the S&P 500 of around 18. And if you look at forward 10-year returns, when you've got a starting point of around 18 in terms of evaluation, the next decade's worth of returns are generally lower anyway, somewhere in the mid-single digits. So that's one supporting factor to the idea that we will see secularly lower returns. The other supporting factor is, I think, and feel free to disagree, Byron, but I think we could be at a secular low or near a secular low on the 10-year Treasury yield. And I think the next decade we could see the beginning of a backup in rates. It may not be a steep backup in rates, but if we do see, at some point all of this debt becoming counterproductive and we start to see a higher 10-year Treasury yield, that further puts, downward pressure on valuation.
Joe, my money is where my mouth is. I own no treasuries in the radical asset allocation. Okay, what are some of the biggest issues facing the U.S.? Well, the economy is one of them, but you're going to hear a lot more talk about the environment and income inequality. There's a lot of talk about climate, and that's going to be an issue in the presidential campaign. Even if we went to zero in the emission in CO2 emissions, we'd still have a world climate problem related to CO2. We represent about 15% of world CO2 emissions. All the rest of the world is 85%. So unless we can get everybody else in line, we're still going to have a carbon emission problem.
Now, this chart is highlighting wealth inequality, and I think everybody generally agrees that post-Great Financial Crisis, policymakers have reflated financial assets at the expense of the real economy. And you can see that on the left-hand side with the S&P 500, its cumulative return, particularly since the great financial crisis. You can see that returns had been higher. The right-hand side illustrates who's really benefited from this, and it is the top 1% who's received the lion's share of the benefit from rising asset prices. The next 9% has shared in that as well. But look at the bottom 50% of this chart. It shows they really haven't participated in the reflation of financial assets. And we know that most of the liquidity has really gone into the financial assets versus the real economy. That's why we're stuck at growth rates that are, in the 2% range. And I think this will continue to become a focus, especially as we do turn the page on 2020 and the election cycle heats up from here.
What this says is the better the economy does, the better the worse the inequality problem becomes. And that's a pretty hard thing to face. Finally, on the national debt and budget deficit, this is one of my favorite charts, because what it says is in the year 2000, if you look at it, the federal debt was around $6 trillion. That's over 200 years of debt accumulation. And the blended interest rate was about 6. So the debt service was 360. Today, the debt is about 22 trillion. The average interest rate is a little over 2. The debt service is 450. So we've had almost a quadrupling of the debt, and the interest rate has gone down by 2/3. That never happens. You can never have debt get that to that size and not have interest rates reflected in some way. So this has been an economic blessing, and we can't expect it to continue. Joe and I agree. The low in the 10-year yield has been reached, and rates are headed higher in the future. Right now, everybody wants to buy our paper, so we can probably endure for a period of time. But the big buyers of our debt, aside from the Social Security Administration, are China and Japan, and they're put off by our trade policies. So my view is they're going to be buying fewer bonds. So at some point in the future, the national debt will become a burden to us. But right now, I think we have another few years before that begins to sink its teeth in.
In a lot of respects, Byron, you see the growth of our debt and our deficit. That's point number one. Point number two, we've heard a lot of talk about MMT, modern monetary theory, and what that might do. What if we're actually living in an MMT world already and we just haven't named it, right? It's like to say, did gravity exist before Sir Isaac Newton put a name to it? When you think about the debt and the deficit, we've increased it massively, yet our funding rates have come down. Isn't that the essence of MMT anyway?
It is, but I'm still not a believer in MMT. So I think at some point, the growth of the national debt will have an impact, a negative impact on interest rates.
Thank you, Byron. And thanks again for everyone who tuned in with us today. In closing, I would like to remind everyone that our next webinar will be January 9th, 2020. And lastly, if there were questions we didn't get to, or if there are other concerns or feedback, please let us know at blackstonestrategy@blackstone.com.